Making the simple complicated is commonplace. Making the complicated simple, awesomely simple, that's creative. Charles Mingus. And Charles makes a great point. To be creative, we don't simply add on every indicator and bell and whistle you can think of when we chart stocks. We don't follow the markets minute by minute, listening to every newscast and trying to decipher the truth from all the noise. We know what the truth is, my friends. The truth is price movement. The reality of the marketplace is what's actually going on with price. Not what people tell you is happening with price, but what's actually happening. Do you notice that you hear all the mavens say the market's going to do one thing and then boom, they're surprised? Then they never apologize. They tell you the next day, the next thing's going to happen, and then it doesn't. Then they never apologize, but they always pretend to be the experts. Well, we don't buy into that. What we care about is what's happening with price movement. We pay attention to our main indicator, which is the price percent oscillator, and we pay a great deal of attention to that in line with all of our other charting techniques. That includes the Heikin-Ashi candlesticks, the derivative oscillator, the Bollinger Bands, and of course our trend lines. So we have all sorts of great stuff to share with you here today, as we do every day. If you've not signed up for an honor subscriber, we'll make that happen. All you got to do is go to chartingwealth.com for free. You can sign up, and we will include you every day with all the special information that we have to share with you. We have a great video that we're sending out to all of our subscribers today. Do what works. That'll help supercharge your training. See that in the show notes. And again, subscribe to get that. We'll talk more about our book that we have for sale and Patreon membership at the end of the broadcast. Let's jump into these charts. Everything down for the day. The S&P 500 down 0.32%. And as we look at things, we see this week again, we still have a green candle that's forming. And it is trying to get, let's see, is it higher than the prior week? 103.13 is the high. Prior week, 300. I say I always tend to go with the 100. Okay, it's 301.13. Some reason I always call the S&P 100. And the previous high was 371. So yes, we have hit a bit of a higher high. We still have a decent sized green up candle. Prices just ticking right up, stair steps going up, well above the weekly trend line. Price percent oscillator not heading up quite as strongly as it was the prior week, but going up. Derivative oscillator gaining upward momentum. That's where we are on the weekly S&P chart. We go to the 2-day S&P chart, and if you recall, this candle now just finished forming. It was halfway done yesterday, and we see that it's reaching a higher high. The box of the candle itself is higher. The candle itself and the wick is a little bit higher. Price percent oscillators lost a little bit of energy, still heading up, however. Derivative oscillators losing momentum. Price is above the 2-day and well above the weekly. Let's look at that 4-hour chart. What do we see there? Well, we saw the 4-hour chart. We got a doji in the morning after a pullback in the afternoon on the S&P. We got a doji in the morning, and then we had a red down candle in the afternoon. Now, because the S&P has rolled over in the 4-hour chart, does that mean that you pull out of any trade that you were in? Negative, my friends. You look at the 2-day and the weekly, all the charts all the time, but you only use the 4-hour chart as your trigger chart. That helps you pull the trigger to get into a trade. It does not then control what you do. So what we are going to look for is, again, continuing to see how strong the 2-day and the weekly are, and see if the S&P is just blowing off some steam, getting ready to move back up. Or again, every down move does start on a small chart, but just because the small chart goes back and forth, back and forth, back and forth. It's done that a few times, but it doesn't mean that it hasn't gone from a low back in June of 273 up to a high of over 300. and it's managed to pull back several times then. So just watch, see what there is to see. Don't let that freak you out. But again, watch your trend lines, watch your Bollinger Bands, watch, all the charts all the time. That's why we practice every single day, so that we can improve our understanding of these charts and make the most of them each and every time we have an opportunity to jump into a trade. We're going to go from the S&P 500 to the Nasdaq 100, down 0.52% for the day. What do we see going on there? Well, remember, we had a weekly vertical crossover back on the week ending the 5th of July. This prior week was an up week. So far, this is an up week. Price percent oscillator heading up, derivative oscillator heading up. Go to the 2-day chart. What do we see there? Still heading up, losing a little bit of momentum, but still pushing up higher on the candle body itself and the wick. Derivative oscillator losing some momentum, but things still going up. Price well above the 2-day and the weekly. And again, what do we see on that 4-hour chart? We saw it crossover going down in the afternoon. So again, it's done that before, blown off some steam and gathered its momentum. So again, continue to watch, see what there is to see. We'll let the bigger charts guide us, both that 2-day and the weekly. So we're now going to go away from our stocks, look at bonds. Now, bonds are not anything we're trading right now. Why? Because the 2-day's in a confirmed down move, the weekly's in a confirmed up move, but maybe getting ready to cross over going down. When that happens, what does that mean for us? Well, if we have a weekly vertical crossover going down on bonds, and it hasn't happened, okay, since all the way back at the end of November of last year. That is a long time for bonds to have been going up. Are we going to have a crossover? Is it going to bounce back off as it's done a couple of times in the past? That is entirely possible. That may happen. Can't say whether it's going to happen or not, but if it does cross over going down, that will be significant. Those of you who are subscribed to our texting service because you texted the word charting wealth, one long word, charting wealth, to the number 33222, you will get a notice of that. Those of you overseas, because our service only works in the States, and those who don't use cell phones for texting, I don't know anybody like that, but there may be some shut-ins. Those of you who aren't subscribed, don't forget that we always talk about those in our comprehensive review and forecast at the end of the week. But you want to sign up, look for how to do it. There's a link in the show notes to do it. We'll do it for you for free. We'll sign you up. Won't cost you a thing, just like subscribing to our daily email, which is our daily review. And it includes once a week our weekly review and forecast, plus all the daily trainings we put out for you. So we see that things are pulling back on the weekly. Still hasn't crossed over yet, so we're still calling the weekly up. You don't call a candle till that candle is fully drawn. What is going on the 2-day chart? Well, we can see on the 2-day chart that we've now drawn 4 down candles, and the derivative oscillator is gaining downward momentum. Price percent oscillator spiking over, going down quite strongly. And we look at that 4-hour chart, and of course it bottomed right around the 129.90 and then up and now down. We'll see. Maybe bonds aren't going to cross over on that weekly chart going down. Maybe they're going to find some support around the 130 mark or so and move back up. We'll see. We'll let the charts guide us, folks. Remember, we are not folks on Wall Street who have to make our living every day trading for a living. So we don't have to trade. We wait for things to be postcard perfect for us to do our trades. That's how you be successful. First rule in trading, don't lose money. Second rule, never forget rule number 1. Back to the weekly chart, and we go lastly to gold. Gold down for the day 0.85%. Are you like me? I have just been waiting so long to pull the trigger on an up trade in gold again. I've so wanted to do it. I had a taste of it just a little while back, and it was beautiful. And then, of course, I sold that trade, did well in it. And again, we're talking about virtual trades here, not a stock calling service. We're an education firm. We want you to practice. But I've been so waiting for gold to move back around. After we had that week ending in the big pullback, that was on the 5th of July. Then we had a bit of an up week over the past week. And so far this week, it's trying to move up, but not moving higher than the prior week. Derivative oscillators losing momentum. Price percent oscillators just about flat. We go from the weekly to the 2-day. What do we see here, guys? We just see a sideways slide. Looks like the 4-hour chart's trying to cross over, going down. Is that going to happen and just continue to deny us? Are things just going to be blocked over and over and over again at the 134 mark? Is that it? Is that all we're going to get? I hope not. I hope that gold is just building, digesting those pop-up gains and getting ready to go higher, higher, higher. And when we see things move away from this red signal line or cross over, that's the pullback. We'll wait for things to move back over and allow us to jump back in. If you're not already in gold and have stayed in gold this whole time, then of course, continue to watch, continue to be careful, pay attention to that 4-hour chart, pay attention to that weakening 2-day chart. Make sure you don't lose what you have gained. But again, never hurts to cut your, look how high gold went. 135.55. I know some of you practice traded it right around the 135 mark, got out, which was absolutely beautiful. Where was our jumping in point in gold? Well, excuse me. We'll get to that when we get to the 2-day chart. But again, I'm sorry, to the 4-hour chart. But again, 2-day chart getting close to crossing over, going down. We go to that 4-hour chart. That is where we see things really starting to tip over, moving away. That's where we did not have the trigger pull. And it gets confusing. But we saw gold rotate over on that 4-hour chart after the build-up and that huge pop. And then it has been tracking down and just has never gotten the momentum that we needed in order to cross over and start heading up for us. Again, pesky, pesky, pesky. We keep hoping for the trigger pull. Some of you probably wanted to jump in early with that 2-day chart. With the 2-hour chart. That is a little dangerous and a little premature. 4-hour chart, one reason we use it is it works for us again and again and again and again. Folks, we so appreciate you being with us. Continue to keep your eye on gold. We're so hopeful that it will, at some point, pop over before that 2-day chart crosses over, going down, and give us a jumping in point in the next day or two. I'm so hopeful. Maybe it will, maybe it won't. Whatever the charts do, we'll follow them and be loyal to them because they tend to almost always be loyal to us. God bless, my friends. All the best from the whole team here at Charting Wealth World headquarters.